Okay, let's jump right in. Nebius Group Q3 2025 results. It's quite the story.
It really is. We're digging into the documents to understand this, well, this core tension.
Huge demand versus not enough stuff.
Pretty much massive demand running smack into some serious capacity limits. It's defining everything for them right now.
Okay, so let's hit those numbers first. The Q3 revenue, I mean, wow.
Yeah.
$146.1 million. That's up 355% year over year.
355%.
And 39% just from Q2. The market noticed too, right? Stock ticked up.
Yeah, 1.68% in pre-market trading. And, the really key thing here is where that growth is coming from.
It's the core AI infrastructure, isn't it?
Exactly. Almost 90% of their total revenue. And that segment grew 400% year over year.
400%.
And 40% sequentially. So even faster than the overall company. Their ARR, the annualized run rate, hit $551 million by September end.
Okay, but growth is one thing. Are they making money? Or, well, losing less money?
That's the other interesting part. The overall adjusted EBITDA loss, it shrunk a lot.
Too much?
Went from about $46 million loss in Q3 last year down to just $5.2 million this quarter.
Okay, that's a big improvement.
But here's the kicker.
Yeah.
The core AI infrastructure business itself, it's actually profitable on an adjusted EBITDA basis.
Really?
Yeah, nearly a 19% margin. That tells you something important.
That this isn't just smoke and mirrors. The AI compute at scale is actually a good business.
It's becoming lucrative, predictable, almost like an annuity. High margin, sticky.
Which brings us to the big problem, or maybe the good problem to have.
The sold out problem, yeah. Management basically said it point blank.
They sold everything they had in Q3.
Completely. Capacity is the bottleneck. It's the only thing holding back even more revenue growth. They just can't build data centers fast enough.
And you see that demand reflected in these absolutely massive deals they're signing.
Right, these aren't small contracts. We already knew about the Microsoft one, that huge $19 billion deal.
Which is staggering in itself. But now there's another one.
The new Meta agreement, about $3 billion over 5 years.
These hyperscalers, Meta, Microsoft, they're essentially locking in their future compute needs with Nebius.
It validates Nebius as one of the, the very few players who can handle this scale.
And the commentary around that Meta deal was revealing.
Extremely. The CEO basically said the only reason the contract wasn't bigger was because Nebius didn't have the capacity.
Think about that. Meta wanted to spend more, but Nebius couldn't supply it.
Yeah. And then the go-to-market executive chimed in.
What did he say?
Pipeline generation was up 70% quarter over quarter. They generated $4 billion in new pipeline in Q3 alone.
$4 billion.
In one quarter.
And he said something like he had to learn a new skill.
Which was?
Having to say no to customers.
Yeah.
Just turning away business because they physically couldn't fulfill it.
Wow. Learning to say no. That says it all about the market right now.
It really does. The demand is just off the charts. And look, for you listening, this capacity crunch, that's why the full-year revenue guidance, while still high, had to be tightened. Right, to $550 million for 2025.
Why?
Because they can't book revenue for capacity they don't have online yet.
Exactly. Even though the ARR guidance, looking forward, is still huge, $900 million to $1.1 billion by year end, they expect to have that run rate, but realizing the actual revenue depends on plugging things in.
Okay, so this supply issue, this bottleneck, it forces their hand on strategy, right?
Completely. It leads directly to the next big number, capital expenditures, CapEx.
Yeah, I saw this. It's a huge jump.
Massive. They raised the 2025 CapEx guidance from $2 billion
to around $5 billion.
$5 billion. That's a $3 billion increase just like that.
That's an incredible amount of money to commit so quickly. What does that signal?
Pure conviction. 1, they are absolutely certain the demand isn't going away. 2, they believe speed is everything right now.
Get the capacity built before someone else does or before the window closes?
Pretty much. And spending $5 billion isn't just buying GPUs, it's the whole package.
Securing power lines, land, construction crews, locking down the entire supply chain, power purchase agreements, land rights, mobilizing construction. It's a massive logistical challenge. Huge execution risk involved.
Let's touch on that risk. If they stumble on building this out, hitting delays with power or land, spending $5 billion could backfire, couldn't it? Leverage concerns.
Absolutely. It's a high-wire act. But look at their 2026 targets. Management is clearly betting they can execute.
What are those targets?
They're aiming for an annualized run rate revenue of $7 billion to $9 billion by the end of 2026.
7 to 9 billion. That's astronomical growth from where they are now.
It is. But what helps make that slightly less terrifying is that they say more than half of that is already booked.
Through those big contracts like with Microsoft and Meta.
Exactly. Those long-term commitments provide some baseline.
But hitting $7 billion ARR still requires a physical build-out that's hard to even comprehend. Let's talk scale.
Okay. Power is the key metric. Contracted power, that's land they've secured where power can be delivered.
They're accelerating that goal dramatically, aiming for over 2.5 gigawatts by the end of 2026. Their old plan was just 1 gigawatt.
2.5 gigawatts. How much power is that, really?
Think like a major city. Seriously, it's utility-scale power and land acquisition. Only the biggest hyperscalers usually operate at this level.
Okay, so contracted power is the potential. But what about connected power? Data centers actually built and ready.
Right, that's the number that translates more directly to near-term revenue. They're targeting 800 megawatts up to 1 gigawatt of connected power by the end of 2026.
So out of the 2.5 GW potential, they aim to have maybe 1 GW baggie actually lit up and earning money.
If they hit that 1 GW connected, yes, that represents enormous cash flow potential. The gap between contracted and connected, that's all about construction speed. That's the biggest variable.
And building all that, spending $5 billion, how are they funding it?
It's a mix. Some standard corporate debt, but also asset-backed financing.
Using the Microsoft and Meta contracts as collateral.
Essentially, yes. Because those contracts are with incredibly creditworthy companies, they should be able to get very good terms on that financing.
So it's faster, maybe cheaper than just issuing more corporate bonds.
Likely, yes.
Yeah.
It's leveraging the quality of their customers to fund the expansion needed to serve those customers. It's about speed.
Interesting. What else?
Also set up an at-the-market equity program, an ATM.
Letting them sell stock directly into the market, up to 25 million shares.
Right. It gives them flexibility to raise capital efficiently if the stock price is strong.
But it also means potential dilution for existing shareholders, especially if they need to use it heavily or if the stock price weakens during this big build-out phase.
It does carry that risk, yes. It's another tool in the toolbox. Seems like they want every possible funding avenue open to make sure this $5 billion plan happens on schedule. Execution is clearly priority number one.
Okay, so the focus is heavily on building raw capacity. But are they doing anything else, product-wise?
Yes, absolutely. It's not just about racking GPUs. They need to differentiate to keep those high-value customers happy long-term.
Like with software or platforms?
Exactly. They launched Nebius AI Cloud 3.0, codenamed Aether. This seems aimed squarely at big enterprises.
How so?
Security and compliance.
Yeah.
It's got HOPIA, SOC2, ISO 27701 certifications, things that banks, healthcare companies, governments absolutely require.
Right, that opens doors to regulated industries that might be hesitant otherwise, no matter how good the hardware is. Data security is paramount there.
Precisely. And they also launched something called the Nebius Token Factory.
Token Factory, what's that?
It's for inference. So running the trained AI models, not just training them, inference needs to be super efficient and cheap at scale.
And does it work?
Well, they cited a major client who apparently saw a 26-fold reduction in their inference costs using this platform.
26-fold? That's a huge selling point. That locks customers in, right? If you can save them that much money on running their AI.
It makes the platform very sticky. It's not just renting hardware. It's providing tools that deliver real ROI.
Okay, quickly then, what about their other businesses? The non-AI stuff.
Still moving along. Every day, the self-driving car unit got a big strategic investment commitment from Uber, up to $375 million.
And they're still planning that robo-taxi launch in Dallas.
Yep, on track for December 2025, apparently.
And the ed tech business, 10.
Also growing well. Revenue up 100% year over year, about 6,000 new students enrolled. So solid performance, but clearly not the main focus driving that massive CapEx spend.
Right. So wrapping this up, Nebius is basically drowning in AI demand, so much so they literally can't fulfill it all right now.
Yeah, the demand is real. It's translating into huge long-term contracts.
And their response is just this massive bet on themselves, this huge capital commitment, raising CapEx by $3 billion to build.
They're trying to bulldoze through the capacity bottleneck because it's the only thing stopping them from growing even faster.
Which leaves us with a final thought, maybe a question for you, the listener.
Right. So Nebius is betting billions that capacity is the constraint, and that it will remain the constraint until at least 2026, according to their CEO. They're spending aggressively to secure power, land, chips, everything.
So the question is,
when does this change? When, or maybe if, does supply finally catch up to the seemingly endless demand in AI? And more importantly, what happened to the companies, the AI innovators, the enterprises who haven't secured their infrastructure pipeline for the next couple critical years? What position will they be in if this supply crunch continues?